Hey guys, welcome back to another exclusive podcast from IronFX. At IronFX, we're dedicated to bringing you the absolute best trading education to help you take your trading to the next level. In today's podcast, we'll be talking about what is correlation and how do you use this correlation to actually improve your trading. Alright, so in trading, if you've been trading for a while, you might have heard this term correlation being thrown around here and there. In super simple terms, it means, how similarly, when one instrument goes up, would another instrument go up? All right. Or if one instrument goes up, would another instrument go down? Right. If it's positive correlation, so you need to think about correlation as a number. It's a number from -1 to 0 to 1. All right. So perfect positive correlation is like a value of 1. Right, so that means when one goes up, the other one goes up exactly the same amount. This is rarely the case in trading, though. Right, there are instances where there's a high positive correlation. What I mean by that, for example, Aussie dollar AUD USD and Kiwi dollar NZD USD. All right, Australia and New Zealand essentially. Right, they have a very high positive correlation. So when Aussie dollar goes up, there's a high chance that Kiwi dollar would similarly go up. All right, not necessarily by the same amount or same magnitude, but enough. Usually, if it follows each other pretty closely. All right, so that's what I mean by positive correlation. Anything above 0 is positive. Right, you can have weak positive correlation, like 0.3, 0.4. Right, this could be something like Aussie dollar and maybe Euro dollar, okay, or Euro dollar and maybe Euro yen, right? They move together, but not all the time. What you're looking for is strongly positive and strongly negative correlation. All right, why? Let me share with you why. All right, so imagine Aussie dollar and Kiwi dollar. You're at a time when they are strongly positively correlated. Maybe give them a value of like 0.9. That means really, there's a really high chance that one would go up if the other goes up. Okay, now you have a trading strategy, right? You have a trading strategy to buy Aussie dollar. Okay, so your trading strategy says, okay, it's time to buy Aussie dollar, right? Then you're like, okay, now I'm just gonna use correlation to just double check my trading strategy, see if there's anything, if there's anything fishy, right? If there's something, wrong with the universe, for example, right? So, you decide to okay, my spidey senses is telling me something might be wrong. You check Kiwi dollar, and by right, if you're expecting Aussie dollar to bounce, Kiwi dollar should similarly be looking to bounce. But you look at Kiwi dollar, and maybe it breaks this massive ascending trend line, right? So it's triggering a bearish move. Okay, so anyone looking at Kiwi dollar will be saying, okay, wow, looks like it might be dropping from here. When you're facing that kind of situation, right, that's how you use correlation to, what's the word for it? You use correlation to prevent yourself from getting into this trade because something is wrong. If both of them are supposed to, both of them are positively correlated, when Aussie dollar looks like it's going to bounce, Kiwi dollar should look like it's going to bounce. Right, so when that is fine, there's nothing suspicious. But when you are looking to buy Aussie dollar, thinking it's going to bounce, and when you look at Kiwi dollar, it tells you a different story. That is when you can actually exercise caution and stay out of the trade, or you reduce the risk that you're allocating to this trade. Maybe you wanted to risk 2% on this trade. Now you adjust it to 1% because you're less confident. All right, so that's how you use something like positive correlation to work. Negative correlation is much like positive correlation, right? Just that, it's kind of moving in opposite directions, right? So a good example is Euro dollar and dollar franc, right? So whenever Euro dollar goes up, dollar franc tends to go down. So this is what I mean by negative correlation. They have a pretty strong negative correlation. I think it's above 0.8, 0.9 most of the time. Right, and how you then use this is similar to what I mentioned, just that you need to flip things around a bit, right? Imagine if you are thinking to buy Euro dollar, right? If you're looking to buy Euro dollar, then your strategy, right? Strategy tells you to buy Euro dollar. You look over to dollar franc, and you're like, okay, technically, if I want to buy Euro dollar, dollar franc should be looking like it is gonna drop, right? Because when one goes up, the other goes down. And you look at euro dollar, you want to buy, and then look at dollar franc, and oh man, it just did a bullish breakout. It looks like it's gonna rise. That is when you should go on high alert and say, whoa, something is not right here. Right? You know, the stars are not aligned. You know, something is a sense of disturbance in the force or something. Right? So that is where you either reduce your risk, or you get out, or you prevent yourself from getting into the trade in the first place. Okay? Because, you know, the correlations are not lining up. And that, my friend, is how you actually use correlation to trade. Right? You actually use it as an additional filter. Right? When something's, compare it with strongly positive or strongly negative correlated instrument. Right? And you should be able to improve your accuracy. Okay? Anyway, guys, that's it for me for today's podcast on correlation. Right? Do remember to subscribe to our podcast, as here at IronFX, we're dedicated to bringing you the very best trading education to take your trading to the next level. Until then, stay safe, trade safe, and peace out, guys.